Hello, and welcome back to another exciting week of managerial accounting. This week, we're going to talk about master budgeting. So, we're really we're switching gears, right? We're going to get away from the costing techniques, and now we're going to look at how do we prepare a budget. So, how does this fit into the course, right? Well, remember, managerial accounting is all about planning and controlling, right? So we have these different costing techniques that we can use to give us data, as well as allow us to control and plan for certain situations or certain parts of the process of manufacturing or providing a service by the way we look at those costs. Okay, so what we're going to do this week is I'm going to go through master budgeting. It should be a relatively quick video here as far as the lecture portion, because a lot of this stuff's pretty self-explanatory. You can pull it out of the book. Some of the discussion questions help you to kind of pull out that important material. But then we're going to go through a lot of budgets or the schedules to the budget. So if you notice in your study guide, there's, oh geez, probably like five or six, I believe, questions or exercises that are geared towards the different schedules of the master budget. So in this video, I just want to kind of do an overview. What is the master budget? What are all their parts, and how do they link together to make that master budget? We do have an exam this week, exam 2, right? It's going to be on chapters 5, 6, and 7. I will have that up tonight. We will make that the due date for that 2 weeks. Okay, so you'll have 2 weeks to complete the exam. So that way you can manage your time a little better. You can stay caught up on chapter 8 material as well as study for the exam and go from there. I will put a review video up for the test. Kind of pretty much what I did before. Hey, if I were you, I would know this. I would know that. There's a question on how to calculate this. Remember, we worked on exercises calculating this, right? So I'll go through that. That'll be put up as well. So let's look at master budgeting. The book really does a pretty good job, I think, at least, of explaining what exactly is a master budget. So I'm not going to waste your time talking about why organizations budget, right? What processes do they use? You can pull that out of the reading, right? And there's some detailed questions in the study guide about that. What I really want to get into, um, bear with me here as we get there. This is what I want to get into, the master budget, okay? And how do all these parts link together, okay? And one of your questions is list the in order the schedules that you have to create to make the master budget, okay? So let's think about that, right? The sales budget. That is the budget or the sales schedule, we'll call it, right? That is the first budget that has to be done in the master budgeting, okay? Or in the master budgeting process, excuse me. The reason why is sales dictate how much we're going to produce. Sales dictate how much selling and administrative expenses do we plan on needing to meet this sales level. What's our ending inventory, right? Well, since the sales leads to the production budget, we then need to figure out, okay, well, how much do we want for um, ending inventory, right? Do we want to pad our inventory so at the end of the quarter or at the end of the month, whatever, we have enough um, inventory on hand to hopefully help with next period sales, whether that's next month or next quarter. Okay, so first is the sales budget. From the sales budget, we do the selling and administrative budget, we do the production budget. Once we have that production budget, we can then go ahead and do the ending inventory budget. Okay. What comes after that? Well, after we have our sales, after we know how much we need to produce, then we can go ahead and budget all our manufacturing costs, right? We can budget the direct materials. How much direct materials do we want to buy? Or let me rephrase that. How much direct materials do we need to meet this sales level that we have anticipated? Okay. Do we want to have direct material inventory? Meaning, do we want to buy enough direct materials that at the end of the period we still have a little bit of direct materials left over so we can use that for next quarter or next month or next period's direct material needs? Okay. From the production budget, we can do the direct labor budget. Then we can do the manufacturing overhead budget. So all three of those are done after we have created the production budget. Okay. So the next probably most important piece of the sales budget, or I'm sorry, of the master budget, is the sales budget. That's what kicks everything off, right? That's what allows us to go and do these other budgets. The cash budget is also important, right? It keeps track of all our cash, right? Cash going in, cash coming out. How much cash do we have at the end of the first quarter? How much cash do we have at the end of the second quarter? What are our predictions? How much cash do we want to have on hand based on on our collections? Okay, so we'll see that. We'll see an example of that as well. The key to recognize is that we cannot do the cash budget until the sales budget has been completed, the selling and administrative budget has been completed, the production budget has been completed, and the DM, the DL, and the MOH budgets have been completed. Okay, because we're buying direct materials, right? That has a cash component. We got to pay for these somehow. How much are we going to pay for materials that we need? Same thing with direct labor. We need a certain amount of direct labor to meet our production budget. Okay, well, how much direct labor do we need, or do we anticipate needing? Okay, well, there's going to be a cost associated with that. So we're going to have different cost or different cash outflows each quarter based on the labor needs. Okay, same thing with manufacturing overhead, right? We have to pay for MOH. We have to pay for, rent, utilities, taxes, all that good stuff, right? Well, they come due in different time periods, right? Different quarters or different months, whatever. So we need to plan that out. Okay. When we do the cash budget, we're going to see that a lot of companies say, you know what? We want to have a certain amount of cash on hand. Makes sense, right? Maybe $5,000. Company says, you know what? At the end of the month, we want to make sure that we have at least $5,000 on hand to get us through to so when we begin the next period, we have $5,000 or $5,000 on hand. We're going to see when we do the cash budget that we may need to institute some short-term borrowing. Okay, and we'll see that when we get there. Once we have our cash budget, or pretty much once we do all the budgets, sales, selling and administrative, inventory or ending inventory budget, production budget, direct material, direct labor, manufacturing overhead budget, the cash budget, then we can do our budgeted income statement and our budgeted balance sheet. Now, these are not actual numbers. That doesn't make sense, right? Let me explain that. It's a budgeted income statement and a budgeted balance sheet. It means that, hey, based on our sales budget, and if everything's perfect and we buy the direct materials we say we're going to buy, we use the direct labor we say we're going to use, we incur the manufacturing overhead we say, we produce what we say we're going to produce, we sell what we say we're going to sell. Here's what our budgeted income statement and our budgeted balance sheet would look like. Okay, so it's kind of at the end of the day, hey, I got all these moving pieces, right? Material, labor, production, sales, selling and administrative expenses. at the end of the day, what does that income look like? What does that balance sheet look like? Okay. So, in essence, it's a planning tool. It's a control tool that we can use to say, hey, if everything goes as planned, here's what it should look like. Okay. So, just keep that in mind. These aren't the income statements and the balance sheets that we're actually going to share with the public. They're not going to go into our financial statements. We are using this as managers to kind of guide our operations to control our operations. Okay. Um, so we have a total of 10 schedules, right? We'll get through those. I'm again very quickly just kind of going to go over them, but we're really going to work on them when we do those exercises. Okay. So the first thing we want to look at, by the way, we are not going to use Excel for the study guide, but what I did was I set up the template for the problems as if it were an Excel spreadsheet. I put tables in there. So just keep that in mind. But the point is that when we're doing this master budget, if we use that software, you know, Excel, excuse me, we can do some what if analysis, right? What if sales change? What if my cost of direct material change? Well, we can play with it in Excel very easily and change a couple numbers and link everything up. Okay, we're not going to do that. We're not going to go that deep. It's not an Excel class. I encourage you to learn Excel if you don't already know it. It's a very powerful tool. So let's look at the sales budget and the expected cash collections. Okay, so right off the bat, they give us the budgeted sales figures for the next 5 months. Okay, that's cool. That helps us out, right? They also give us the selling price. Fantastic. Right off the bat, we can figure out not only the units that we need to produce because of the sales budget, but we know hopefully the cash or the sales revenue that we'll generate each quarter because we have the sales price. So if you notice here, to figure out the sales budget, it's pretty simple, right? I mean, there's not much to it. It's very intuitive if you think about it. We know right off the bat, sales or selling price times number of units sold gives me my total sales, right? Doesn't matter if we're looking at budgets, if we're looking at CVP analysis, that, what's the word I'm looking for here? That concept applies. So I can very easily do my sales budget. All I do is take my sales for April, multiply it by the selling price. That gives me my total budgeted sales in dollars. Okay, very simple. Now that I have this, now that I have the amount of units that I need to create, as well as the total sales volume in dollars I can go ahead and create my production budget, right? I can create my production budget and I know exactly how much I need to produce each month. Okay. Now we need to look at collections. When am I going to collect this cash? Okay. Now, in the book world, they're going to tell us, right? Hey, the company recognizes that in the month that they have a sale, they collect X percentage of that month's sales in that month. Okay. What are you talking about? Well, in April, or what month are we here? Yeah, April. In April, we collect 70% of April sales. Well, there's 100% of sales. What happens to the other 30%? Those are collected in the following month after the sale. Okay. So it's really important that you recognize that we're collecting a portion of the sales in the month of the sale, and then we're collecting a portion of the sales in the month following the month of the sale. Okay. So they tell us that in April, the March 31st accounts receivable balance is $30,000. Okay. So that means, and we got to think back, in March, we had X number of sales. Okay. 70% of March's sales were collected in March. 30% of March's sales were not collected in March. They're going to be collected in April. So in April, we're going to collect 30% of March's sales, which ends up being $30,000. Okay. So here's what we do. Let's just kind of look at it here. All right. So here's how we put all this together, right? We're going to track how much cash we are receiving from our sales budget based on our, well, what they give us, um, our collections based on what they said in the book. But in the real world, you're going to look back at past experience and say, you know what, on average, we probably collect, I don't know, maybe 50% of a month's sales in the month, and the other 50% is collected in the following month. That could be a possibility. Okay. Point is, this 70-30 rule, it's just they just threw darts at a dartboard and said, how much am I going to collect in the month of the sale? How much am I going to collect after? In the real world, you look at in the past, what have we collected, right? So we know in April we're going to collect all of March's accounts receivable, which is $30,000. Great. So then we have more cash that we're going to collect in April, right? April has sales of, I think it was $200,000. We know that 70% of April's sales is collected in the month of April. So that's how we get the $140,000. That's 70% of April sales. Well, there's still 30% left, right? 30% of 200 is $60,000. When am I going to collect that other $60,000? Oh, I'm going to collect that in May. Okay. And then we do the same thing. Let's look at May sales. Okay. May, I sell $500,000. Well, I know in the month of May, I'm going to collect 70% of May's sales. 70% times 500,000 gives me $350,000 that's collected in the month of May. Now, there's still 30% of May's sales that I haven't collected. I anticipate collecting those in the future, particularly in June, the following month after the sale. So I take my $500,000 May sales and multiply it by 30%. It's $150,000. That is the sales, or the amount of May's sales I'm going to collect in June. Okay? So we want to know what's the total cash collection for the period. Well, that's easy, right? We just have to do June. And it's 940,000. Okay? Now, I want you to notice something here real quick. They're going to ask us, and we're going to have to calculate it, and we'll do it in an example, but I just kind of want to show you. So we have June sales, which is $300,000. We know that 70% of that is collected in June. 30% of that is going to be collected in July, the following quarter. So we now have an accounts receivable. We have 30% of June sales will be collected in July. So as of June 31st or June 30th, excuse me, we need to show that, hey, we have sales that we have made that we have not yet received the cash for. I anticipate receiving that cash next month. Okay. So the accounts receivable will be $90,000. How'd you get that? Well, I took June sales, 300,000 times 30%, which ends up being $90,000. Okay. Now we can go ahead and do our production budget. Production budget's really simple because we already know how many units we're producing. How do we know how many units we're producing? And hopefully you said, because we already did the sales budget. Now, once we have completed the sales budget and the expected cash collection, we can go ahead and do the production budget. Okay? How do we do the production budget? Well, we need to know some information first, right? What do we need to know? We need to know, does management have any expectation or any desires is a better word, of having any ending inventory at the end of the month or the end of the quarter? We're working with months, so we'll stick with months. what's that mean? Well, that means that in the month of June, I want to produce enough to meet June sales, plus I want to produce a little more so I have some percentage of next month's sales. Okay? In this case, they want to have 20% of the following month's sales budget. So that means in June, I need to produce enough to meet June sales, and I need to produce a little more so I can have 20% of July's production needs. Okay? They tell us that on March 31st, 4,000 were on hand. So that means that when we start on April, we have 4,000 units, already made. Okay. So the first thing we do is we plug in what's our budgeted sales in units. Well, we got 20,000, 50,000, 30,000. So for the entire quarter, we plan on selling 100,000 units. Okay, great. To that budgeted sales, I'm going to add my desired ending inventory. That's going to give me the total amount that I need to produce for that month. Then I'm going to subtract out the beginning inventory. That's going to give me the required production. Okay. If I were you, I would jot this down on a note or a little note card or in your notebook, whatever. Okay. Because this, and I hate to say this word, I'm going to say a bad F word, this formula is going to basically drive this budget, this production budget. Meaning we're going to start off with budgeted sales in units. To that, we are going to add desired ending inventory. That's going to equal the total production needs for the month. Then we subtract out beginning inventory. That tells us how much we actually need to produce in that month. Okay? So let's continue to look at this. Well, we know that the desired ending inventory is 20% of the following month's budgeted sales in units. In May, I expect to sell 50,000 units. So in April, I want to make sure I produce 10% of that. Okay? Or I'm sorry, 20%. 20% of that. So I get the desired ending inventory of 10,000 units. Okay? So that means my total needs for the month of April is the budgeted sales of $20,000 or 20,000 units plus desired ending inventory of 10,000 units. Great. So at the end of the month or through the month of April, I got to produce 30,000. But when you think about it, I already began April with some beginning inventory, right? They said March 31st ending inventory was 4,000 units. Well, 1 month's ending inventory is going to be the following month's beginning inventory. So my beginning inventory in April was 4,000. That means that I need to produce 26,000 units. Okay? So, what's the required production for May? Well, let's go through this. And bear with me here. Okay, I'm going to draw. All right. So let's think about this. The desired ending inventory. Okay. Well, desired ending inventory, I want to have 20% of June sales. Okay. Well, what are June sales? June sales are $30,000. Okay. I want to have 20% of that. So the desired ending inventory in May is going to be, if my math's right, 6,000. Okay. So I have $6,000 here. Okay. So that means that my total needs for the month of May are 56,000. I need 56,000 units at the end of the month. That's supposed to be 56,000. My comma's all messed up. Okay. But I started this month with how much? 10,000 units, right? The desired ending inventory in April was 10,000. That means I started May with 10,000 units. So how much do I need to produce, or what's my required production? Well, that is $46,000. And let's see if we're right. Yep, 46,000. And they go through the calculation with us again, right? Now, notice that June ends the quarter with 5,000. That's because that's 20% of July's sales. Okay, so the next thing we can do is we can prepare the direct materials budget and the schedule of expected cash disbursements for purchases of material. That makes sense, right? So after we do the production budget, now we can go through and do the materials, labor, and overhead. Okay, now they're going to give us some information, right? They're always going to tell us some specifications of the project and how much material we need. They're always going to tell us, oh, by the way, at the end of the month, we want to have X amount of the following month's inventory needs. Okay, cool. They're going to give us a price on how much the material costs. So we can go ahead now and prepare the direct materials budget because we know that it takes 5 pounds of material for 1 unit. We know that we want 10% on hand at the end of the month for the following month's production. We also know that as of March 31st, we have 13,000 pounds of material on hand, and that material is going to cost us 40 cents per pound. Okay? So, first thing we do is we say, what are our production needs? Well, guess what? We already got that from our production budget. Okay? So what we need to do is calculate out how many units do we need, right? Meaning how much raw material do we need for the entire production. Okay? We know that there's 5 pounds of material go into making 1. So we multiply the production, this is units here. Oh, why did I do that? Sorry. This is units times how much material is needed per unit. So that means that we need to purchase at least 130,000 pounds of this product or this material. Okay? But when you think about it, we already started the month with a certain amount of that material on hand, and we need to include the following month's production needs, right? 10% of it. So what I do, oh, sorry. Okay, so what I do is I add my desired ending inventory. At the end of the period, I want to have 23,000 pounds of this material. How did I get that? 10% of the following month's production needs. In May, I'm going to need 230,000 pounds. So I better end April with 23,000 pounds. Okay. So I get my total needs. Then I subtract out my beginning inventory, which they already told us was 13,000. That came from March 31st, their ending inventory balance. So so how much do I need to, oh, damn it. How much do I need to produce? How much do I need to purchase? I got to purchase 140,000. Okay. Again, if I were you, I would jot down, hey, production needs or direct material budgets. I start off with my production in units. I multiply material needed per unit. That gives me the total production needs or product needs. Okay. I don't like his product needs. That's kind of total amount of direct material needed, right? I need 130,000 pounds of this direct material. I then add in my desired ending inventory. That gives me the total amount of material or direct material that I need. I subtract out my beginning materials inventory. That gives me the materials to be purchased. So I would write that down, this formula, because this is going to help us out whenever we go ahead and do those problems. Okay? So, and again, we're just going through the direct materials budget here. Remember, 1 month's ending balance, and we see right here desired ending inventory in April, becomes May's beginning inventory. Okay? That concept's very important. Okay, so now we look at the cash disbursements for material, right? So in order to do that, we know that it's 40 cents per pound. We know that we have a certain amount in April that we have to pay from March. And as a company, we have a policy of whenever we purchase something, we pay for it half, where we pay half the price or half the cost in the month of the purchase. We pay the other half the following month. Okay, cool. So how do I do the cash disbursements? Well, I start off with my accounts payable as of April 31st. I know it's 12,000. Okay. Then I got to figure out April's cash disbursements. Well, it's easy, right? I need 140,000 pounds that needs to be purchased in the month of April. Where did I get this from? I got it from my production budget. My production budget says materials to be purchased is 140,000. Okay? So, I take 140,000 times 40 cents per pound. I get $56,000. So, all the material that I need to purchase in April is going to cost me $56,000. I'm not going to pay all $56,000 at once. I'm going to split it up. I'm going to pay half of it, half of April's purchase in the month of April. I'm going to pay the other half in the month of May. Okay, that makes sense. So let's look at May. Well, in May, I know that my sales in May, bear with me here, I'm sorry. My production needs in May were 221,500. Right? So if I take 221,500 times 40 cents, that ends up with being 88,600. Half of this is going to be paid for in May, which I see here, the 44,300. The other half is going to be paid in June. Okay? This is just like the sales budget. Instead of collecting cash, now we're going to pay it out. Okay? Same concepts. Direct labor budget. We can do that next. We have all the information we need, right? What information do we need? Well, we need to know, in order to prepare the direct labor budget, we need to know the number of units we need to produce, which we already know that. We also need to know, hey, how long does it take to make a unit, right? So they tell us that it requires 0.05 hours to make a unit. 3 minutes. It takes 3 minutes to make a unit. Okay. We have unskilled labor doing this. That's important because we can pay our workers a little less, right? If we had skilled workers doing this, we'd probably have to pay them more. So we're paying our unskilled workers $10 an hour. We know how we know how many units we need to produce each month. We know how long it takes us to produce each unit, and we know how much we pay them per hour. We can make the production budget. So notice here, where are we starting out at? We're starting off with the units of production. We got that from the production budget. Okay. Then we say, okay, how many or how much time does it take per unit? Well, it takes 0.05% of an hour or 3 minutes. So we take 26,000 units times 0.05. We're going to incur, again, in the month of April, 1,300 hours to make this product, or to make 26,000 units that we need to produce. Okay. The hourly rate is $10 per unit, or $10 per hour. Total direct labor cost is going to be $13,000. We do the same thing for May. How many units do we need to produce in May? 46,000. The direct labor time per unit is 0.05. We multiply those out. That means that we need direct hours, or direct labor hours, to make that 46,000 units. We need 2,300 hours times $10 gives us our direct labor cost. Okay, so that's pretty easy. Manufacturing overhead budget. Again, we need to know a few things, right? We need to know what our fixed costs are. We need to know what our variable costs are for manufacturing overhead. We also need to know depreciation. Why? Well, because depreciation is a non-cash expense. We're trying to figure out what our manufacturing overhead is, how much is it going to cost us in cash, right? We need to back out depreciation because depreciation is a non-cash expense. That's not going to affect our cash, right? So, in order to do the manufacturing overhead budget, it is based on direct labor hours. So we need to do the direct labor budget in order to do the manufacturing overhead budget. Okay? Now, we have this formula that we need to know. Okay? We start off with the budgeted hours from the direct labor budget, and to that we add our variable manufacturing overhead rate, which is $20 per direct labor hour. Okay, they already told us that in the problem. So we take the budgeted direct labor hours times the variable overhead rate. We get the total variable overhead cost of being $26,000. We then add our fixed costs. So we get $76,000 in manufacturing overhead costs. Okay. So let's kind of pump the brakes for a second here, right? We can figure that out per hour. What is our manufacturing overhead per hour? Well, that's easy. We could take our total manufacturing overhead for the quarter, which we end up getting $251,000, divided by the total direct labor hour, which is 5,050. We get $49.70 per hour. That right there, my friends, is a predetermined overhead rate, right? That's what we're doing. We just broke it down into quarters, and we're saying, hey, because we're budgeting, we have no idea. Here's what we anticipate on scheduling, paying, incurring, selling. Based on these estimates on our budget, here's our predetermined overhead rate. Okay? So, once we get that 76,000, we need to back out depreciation. Depreciation is a non-cash expense. So now we have our cash disbursements for manufacturing overhead of 56,000. Very important that you understand, and I maybe jot this down so you understand this concept. We calculated the predetermined overhead rate by taking the variable MOH and the fixed MOH, right? Based on direct labor hours, based on this total estimated overhead cost that we have for the quarter. Once we have that total manufacturing overhead costs, because we include depreciation in manufacturing overhead costs, However, when we're worried about the cash disbursements for those manufacturing overhead costs, we got to back out depreciation. We got to subtract out that non-cash cost, which depreciation is. Okay? So then we can go ahead and do our finished goods budget, right? We know how much it costs us, right? Direct material takes 5 pounds per unit, costs us 40 cents. That's $2 of direct material. Labor, direct labor, we use 0.05 hours times 10 bucks per hour. Basically, we're paying our labor 50 cents per unit. Okay? Manufacturing overhead, it's based on direct labor hours. 0.05 times our predetermined overhead rate, 49.70. It should cost us, it should cost us $4.99 per unit. That's our unit product cost, $4.99. Okay? So we need to figure out what is our ending inventory. Ending inventory in units, right, is 5,000 units multiplied by the unit product cost of $4.99. We get our ending finished goods inventory of being $24,950. Okay. Okay. Last thing we could do, or the last budget really that we need to do, is the selling and administrative budget. So again, we're doing the same. This looks identical to the variable, or I'm sorry, this looks identical to the manufacturing overhead portion, right? As far as the calculation goes, we're going to have selling and administrative variable expense. We're going to have a fixed portion. And guess what? We're probably going to have a depreciation component of those fixed selling and administrative costs. We do the same exact thing. We start off with our budgeted sales in units. Basically, we're saying that, hey, the variable selling and administrative rate is 50 cents per unit we sell. Well, in April, we plan on selling 20,000. We get our total variable expense. We add in our fixed. That gives us our total selling and administrative expense of 80,000. We subtract out that non-cash expense of depreciation. Okay. Preparing the cash budget. This is awesome. We've already done the work, right? We've already done it. We might not realize we did it, but we did it. We did our expected cash collections from our sales budget. We did our expected cash disbursements for direct material, direct labor, manufacturing overhead, and our selling, general, and administrative. Okay. So remember, when we're talking about cash receipts, those are nothing more than cash inflows, right? Money we're receiving. Cash disbursements, those are cash outflows. Those are payments we make. Okay. We will have borrowing here, and I'll show you an example of that. And then we have a finance section. We're going to have a finance section within the cash budget. So they give us some information, right? We have a 16% open line of credit for $75,000. We require a minimum cash balance of $30,000 on hand. Okay? If we need to borrow, meaning if at any time during the end of the month, let me phrase that, anytime during the quarter, if we get to an end of the month and we see, our cash balance is not $30,000, we're going to tap into that line of credit and get us enough money to get us to that $30,000 balance. Okay? If we have to borrow, we're going to borrow on the first day of the month. We're going to pay the loan on the last day of the month. That's going to help us out with interest charges. Okay? They tell us that, hey, we're going to pay a cash dividend of $49,000. We also bought some equipment in May, right? We also bought some in June. They give us our beginning cash balance. Okay? So, let me just kind of go through this here. Actually, let's go through it piece by piece. So we start off with our beginning cash balance in April. To that, we add all the cash we collected. Where do we get that from? Well, the schedule of expected cash collections. That gives us the total cash available of $210,000. We then subtract out all our cash disbursements. Well, cash disbursements for materials come from the schedule of expected cash disbursements, right? Direct labor, that comes from the direct labor budget. Manufacturing overhead, the cash portion, manufacturing overhead budget. Selling and administrative costs, guess where that comes from? Selling and administrative budget. Then they say, oh, by the way, you pay a dividend, $49,000. Okay. So our total disbursements are $228,000. We have a negative balance of $18,000 in our cash account. It's okay. We got a line of credit. We are going to borrow enough to get us to that $30,000. Okay? So we're going to borrow $48,000 from our line of credit. Notice we put that in our financing charges, right? Borrowing $48,000. So that means that the total cash or the ending cash balance is $30,000. Guess what? I start May with the same thing, $30,000. I add my cash collections. Where do I get my cash collections from? Cash schedule of cash receipts, right? I subtract out all my disbursements, direct materials, direct labor, MOH, selling and administrative. I end up with $40,000, okay? At the end of the month, I have excess cash. I took in, including my beginning balance and what I took in $440,000. I dispersed $400,000. I have $40,000 left. We're not going to repay our loan. We're only going to repay it when we can repay the whole thing. So we have an ending balance of $40,000. So let's look at June. We do the same thing for June. Okay. We have, once we factor in the total cash we have available, we factor in all our cash disbursements. You see in red there, we have $130,500 in excess, right? Meaning cash receipts over cash disbursements. Now I'm going to repay my loan. I'm going to repay the $48,000, and then I need to calculate interest, right? Well, we borrow $48,000 at 16% times 3/12, right? Why 3/12? Well, it makes it easier because I just assume I borrow on April 1st and I repay it on June 30th. That's how you do the cash budget. Now, once we have the cash budget, we can do the budgeted income statement, okay? Again, we are going to do the traditional income statement, so I'm going to assume you guys are comfortable with that. What we do now is just plug and chug, right? We go to the sales budget, pull the sales. We go to the finished or the ending finished goods inventory to figure out what our cost of goods sold were. We go to our selling and administrative to figure out what our selling and administrative expenses were. Interest expense, we get that from the cash budget. We then got our net income. Okay? Doing the balance sheet, same thing. We're looking at 30% of June sales to figure out what our AR is. We're looking at the raw materials inventory. How much do we have left over in poundage times the price? Same thing with units in finished goods, right? The finished goods raw material, or I'm sorry, the finished goods ending inventory balance. Our accounts payable, we go to our disbursements and look at that, right? The direct material budget, that tells us how much we owe at the end of the month. Okay, so that's pretty much in a nutshell a very quick overview of chapter 8. I'm starting to realize I probably should have broke this down in 2 videos. I apologize and thank you for sticking with me. Again, gave you some important notes kind of to take. We're going to come back and we're going to put all this stuff into action, right? We're going to work on those problems in our study guide. Okay, so we will see this again, and we'll see it a little more slowly, and we'll see how we calculate everything. Okay, so tune back in for that video, or those videos actually.